How was the Federal Reserve System created? Have you ever wondered how the Federal Reserve System came to be? The story begins on December 23, 1913, when President Woodrow Wilson signed the Federal Reserve Act into law. This act was a response to a series of financial crises and banking panics that plagued the United States in the late 19th and early 20th centuries. One of the most notable events was the Panic of 1907, which revealed serious weaknesses in the banking system, such as an inflexible currency and a lack of liquidity. Before the Federal Reserve was established, the country faced frequent bank runs. Customers would rush to withdraw their deposits, leading to bank failures and economic instability. The existing national banking system did not have a central authority to provide emergency funds or effectively manage the money supply. To tackle these issues, Congress passed the Aldrich-Vreeland Act in 1908. This act created the National Monetary Commission to study potential banking reforms. The Commission's recommendations were influenced by a secret meeting held on Jekyll Island, where leading bankers and legislators gathered to discuss solutions. These discussions eventually formed the foundation of the Federal Reserve Act. The Federal Reserve System was designed as a decentralized central bank, featuring a board of governors located in Washington, D.C., and 12 regional Federal Reserve banks situated in major cities across the nation. Member commercial banks in each region contributed capital to their local reserve bank, which allowed them to access loans and services. National banks were required to join, while state banks had the option to join voluntarily. One of the key innovations introduced was the Federal Reserve Note, a new type of currency that could be quickly circulated. This created an elastic currency that could expand or contract based on the economy's needs. The Federal Reserve also established the discount window, enabling member banks to borrow money using short-term loans as collateral. This feature helped banks manage liquidity and acted as a safety net to prevent bank runs by serving as a lender of last resort. Initially, the Federal Reserve's primary goal was to stabilize the banking system and prevent financial panics. Over time, the role of the Federal Reserve expanded to include setting monetary policy, supervising banks, maintaining financial stability, and providing financial services to the government and other institutions. The creation of the Federal Reserve System marked a significant turning point in American financial history. It established a central institution to oversee and stabilize the nation's monetary framework, addressing the pressing need for a more resilient financial system capable of supporting the growing economy and preventing the damaging effects of banking crises.